On June 23rd, $100 just vanished from the price of gold overnight.
Just completely wiped out.
Right. The ultimate financial anchor didn't just drag. It was basically dropped out of an airplane. It decisively broke that massive psychological barrier of 4,200 United States dollars.
Yeah, that was a huge moment.
It really was. So welcome to today's deep dive. We are unpacking the June 23rd gold and silver market news bulletin. And the mission today is to figure out exactly why this sudden collapse happened and, analyze the strategic game plan for you, the investors who are caught in all this volatility.
There's definitely a lot to unpack here.
Absolutely. Joining me to make sense of this structural collapse is senior market analyst Michael Anderson. And before we get into the nuts and bolts, if you are finding value in navigating this market with us, please take a moment right now to like this video, subscribe to the channel, and leave a comment to share your opinion as we go.
We always appreciate seeing those comments.
We really do. So, look, the sheer speed of this overnight drop, it was like a trapdoor just suddenly opening under the entire precious metals market. How does a massive floor like that just give way so quickly?
Well, to understand that, we first need to look at the exact timeline of the crime scene, basically. Because the damage didn't actually start with gold.
Wait, it didn't?
No, it didn't. Silver was actually the canary in the coal mine here.
Oh, interesting. So what did that timeline look like? Let's walk through the hours. Because at 9 o'clock the previous evening, gold was still hovering right around $4,200 per ounce, right?
Right. It looks relatively stable.
Yeah, but then that intense selling pressure hit, driving it down continuously until 4 in the morning, where it finally bottomed out at $4,092 per ounce. And it's currently hovering around $4,115 in the morning session.
Exactly. But if you rewind the clock, the plunge in silver started much earlier, around 9 o'clock in the morning the previous day.
Wow, so a full 12 hours earlier.
Yeah, massive lead time. Silver plummeted $5 from 66.8 down to 61.8 United States dollars per ounce.
That is a violent drop.
It really is. It lost its upward momentum noticeably faster and just much more aggressively than gold did. And this wasn't just an isolated event.
Right. The bulletin mentioned other metals, too.
Exactly. Platinum and palladium both fell roughly 3% as well. So what we're looking at is a broad, systematic withdrawal from all precious metals.
So why does silver often act as that leading indicator in these massive sell-offs? Like, is silver's sharper drop a warning sign that there is further pain coming for gold?
It is, yeah. Because silver is a smaller, less liquid market compared to gold. So when huge institutional money decides it needs to exit the precious metal sector, their algorithmic selling hits the thinnest books first.
So silver just can't absorb that kind of volume.
Exactly. Silver breaks down early and aggressively because it's the mechanical footprint of the big money getting out.
Okay, that makes sense. But a sector-wide drop like this doesn't just happen in a vacuum. The momentum was completely crushed by two massive macroeconomic forces moving in tandem.
Macro wrecking ball.
Right, the macro wrecking ball. The bulletin points to two main culprits here. First, the United States dollar index surged to over a one-year high, hitting 101.17.
Huge move.
And at the exact same time, the 10-year United States Treasury yield crossed that crucial 4.5% threshold, hitting 4.501%.
And that number is everything. That 4.5% line changes the entire game.
So explain the mechanics of that for us. Why does that specific yield trigger such a massive sell-off in gold?
It comes down to opportunity cost. You have to remember, gold yields no interest. It doesn't pay a dividend.
Right, it just sits there.
Exactly. So when Treasury yields spike past 4.5%, big money moves to the guaranteed return of government bonds. If you are a portfolio manager, you can't justify holding an asset with zero yield when you can lock in 4.5% risk-free.
So it's basically like, imagine you have your money sitting in this beautiful, highly secure safe. It's safe, but it's not doing anything.
Exactly.
And then suddenly you have a tenant who offers to pay you double the rent if you just lend them that money. Eventually, you are going to take the cash out of the safe and rent it out.
That is a perfect analogy. You follow the yield, and on top of that, you have the surging dollar. Because gold is priced in United States dollars globally, a strong dollar makes gold inherently more expensive for any investor holding foreign currencies.
Right, so global demand just gets dampened across the board.
Precisely. You have institutional money running toward bond yields
Yeah.
and physical demand drying up because of the exchange rate.
So it's just a double whammy for the price.
Right.
But usually, when macroeconomic conditions are this harsh, gold can sort of rely on global tension to keep its safe haven premium elevated, right?
Usually, yes. Fear is a great floor for gold.
But right now, according to the bulletin, that premium is evaporating. And this brings us to the geopolitical factor. The latest on the United States and Iran situation is that Pakistan, acting as an intermediary, reported some positive progress after a first round of talks.
Right, we saw those headlines hit.
Yeah, and the United States has temporarily eased some Iran-related sanctions for a 60-day period. Now, I want to be super clear here for everyone listening. We are strictly reporting what is in the news bulletin. We are completely neutral, not taking any left-wing or right-wing political sides whatsoever.
Absolutely. We are only analyzing how these events move the financial markets.
Exactly. We are just the messengers for the source material. So, looking purely at the market reaction, how does this diplomatic progress directly hit gold?
Well, as those geopolitical risks ease, the panic buying of safe haven assets just stops abruptly. The fear premium vanishes.
Just like that.
Just like that.
Yeah.
And we see this mirrored perfectly in the oil market. Brent crude dropped to roughly 77.8 United States dollars per barrel.
Wow.
And West Texas Intermediate went down to around $74 per barrel.
Because of reduced supply fears, right?
Exactly. And when oil drops, that cools off overall inflation expectations, which, again, removes another fundamental reason people buy gold.
I have to push back on this a little bit. Is a mere 60-day temporary easing of sanctions really enough to permanently drain that fear premium out of the market? Or is the market just being wildly, overly optimistic here?
That is the million-dollar question. The market algorithms trade the headline instantly. They don't wait to see what happens on day 61. They see tension decreasing today, so they sell the safe haven today.
So it's all short-term reactive.
Very reactive. And with geopolitics currently taking a back seat, the market steering wheel has been handed completely over to institutional data watchers and fund flows.
Right, the waiting game. The bulletin notes that the market is essentially holding its breath for the biggest event of the week, which is the United States personal consumption expenditures data.
The inflation metric the Federal Reserve watches most closely.
Exactly. Along with the Purchasing Managers Index, unemployment figures, and of course, upcoming Federal Reserve speeches. And the formula here is pretty simple, isn't it? High personal consumption expenditures equals a strong dollar, which puts more pressure on gold.
Spot on. And low data could spark a recovery. But there's a massive institutional tug-of-war happening underneath all this data.
Right, the exchange-traded funds. Let's talk about those.
Yeah, this is a critical variable from the sources. We know that central banks are still buying gold for their long-term reserves.
They are accumulating steadily.
Steadily, yes. But that underlying support simply isn't enough to counteract the massive short-term cash withdrawals we are seeing from exchange-traded funds.
It's just a flood of selling.
Exactly. Retail and institutional investors are dumping their paper gold shares, which forces the funds to liquidate physical gold into the market. Without that exchange-traded fund money flowing back in, any short-term rally in gold will likely just be sold off.
It's like, think of the central bank buying as the sturdy foundation of a house, right? And the exchange-traded fund flows are the weather.
I like that.
So right now, the foundation is holding firm, but a massive hurricane is just tearing the roof completely off the house.
That is exactly what is happening. The weather is brutal right now, even if the foundation is solid.
So armed with all this knowledge, knowing why the drop happened and what the big money is waiting for, we need to translate this into a practical strategy for the listener's portfolio.
Let's get into the strategy, yes.
Because the short-term and long-term realities are completely different right now. Let's map out those short-term danger zones first.
Okay, so for gold, the immediate support zone to watch, the floor it needs to hold, is between 4,050 and 4,100.
And if it bounces from there?
Then the resistance it's going to hit is right around 4,150 to 4,180.
Okay, and what about silver?
For silver, that support level is at 62, and resistance is at 63.5.
Got it. So where do we go from here?
Well, a medium-term test of the 4,000 level for gold is highly possible. Maybe not this week, but it is on the table if this selling pressure keeps up.
Right. But we have to emphasize a really crucial message from the bulletin here. The long-term upward cycle for gold is not broken.
Not at all.
Global reserve diversification, central bank accumulation, that is all still happening in the background.
Yes, the structural bull market is intact. But the investment playbook for right now has some very strict warnings based on the June 23rd recommendations.
What is rule number 1?
Do not chase rallies.
Don't chase the green candles.
Exactly. And do not try to catch the bottom all at once. The priority right now is to divide your capital, maintain a healthy cash ratio, wait for technical confirmation, and buy in tranches, small portions, only during confirmed corrections.
Okay, but let me ask you this, because this is where a lot of people get tripped up. How does a retail investor practically define waiting for confirmation?
That is a great point.
Because you don't want to jump the gun and end up catching a falling knife, right?
Exactly. Waiting for confirmation does not mean watching the price go up for an hour on a Tuesday.
Right.
It means waiting to see the price hit one of those structural support levels we mentioned, and then actually consolidating there over multiple daily trading sessions. You want to see the panic selling exhaust itself. You need the ground to stop shaking before you step out to build.
That makes perfect sense. So, let's briefly recap this perfect storm that caused June 23rd crash. We had a surging dollar, treasury yields breaking 4.5%, easing geopolitical tensions, draining the fear premium, and a massive exodus from exchange-traded funds.
A textbook combination for a price collapse. But I want to leave the listener with a final thought to really mull over.
Please do.
If the long-term foundation of central bank buying is still totally solid, which it is, and they are absorbing all this cheap gold, what kind of explosive upward pressure might we see if or when the macroeconomic weather finally forces all that massive exchange-traded fund capital to pivot back into precious metals?
Wow. Yeah, it's basically a coiled spring at that point.
Precisely. When the yields drop, that money has to come back.
That is an incredibly provocative thought to leave off on. And that brings us right back to you, the listener. We want to know what you think based on today's bulletin. Do you think gold will hold the 4,100 zone, or is it destined to drop deeper?
We would love to hear your forecasts.
Definitely. Drop your forecasts in the comments below. And if you enjoyed this deep dive, please remember to like the video, subscribe to the channel, and hit the bell so you don't miss our next analysis.
Thanks for tuning in, everyone.
Stay sharp out there, and we will catch you on the next deep dive.